Welcome back, everybody, to We Are TPM. I'm here again with John Teixeira, myself, Kyle Teixeira, and we are going to be discussing this week a recap 2022's market outlook and a outlook at 2023.
That's right. I mean, we're gonna put on our crystal ball goggles, right?
Yeah.
And try to figure out what's gonna happen next year.
We're gonna use our great memory and give some crystal ball outlooks. But if you guys are interested in anything we have to discuss, or have any questions, or just want to talk to John or I or anybody on our team, give us a call. 817-818-9039. That is the number to We Are TPM. Or shoot me an email or us an email at ShowMeTheMoney@wearetpm.com.
Did you get like Norwegian there for a moment?
Is that what that was? I don't know what you would call that.
So Swedish kind of thing feel going on there.
Been watching too much of the World Cup.
You know, we just got done with Thanksgiving, and so we're into the holiday season, and people start recapping and looking at the coming year and what's going to happen. And gosh, we've got a lot of changes going on, right? Things are happening in every corner of our economy. So we thought it would be a good idea just to recap 2022 real quickly and look ahead. We've been listening and getting our feels out about what's going to happen in 2023, so we're prepared for that, and we just want to share that with everyone, right?
Yeah, I mean, there's a lot of market cycles that occur in the rental market always, and this year's been a different one because it's just been a lot of cycles happening very quickly.
Yep.
So that scares some people, but in reality, just it's like anything else. You need to forecast. You need to know what you're dealing with and execute. So, I mean, at the beginning of the year, as far as the recap goes, we started out the year with the continuation of 2021 of a very strong rental market. Very strong economy at that point, and like everything else, the pivots started to come probably in March, right? Yeah.
No, I would say a little bit later. Actually, you mean I don't know what pivot you're referring to, but I'm just thinking right now. I'm thinking about like rental rates and activity.
Oh, that didn't slow down.
It didn't slow down at all. It kept going up, and activity was going crazy until I would say August. Mm-hmm. About August, September is when somebody put the brakes on everything, right? And didn't just put the brakes on, but kind of slammed on them a little bit, huh?
Yeah, because the rental market, and what I meant by pivot was the rental market kept increasing, right? At a higher rate. And that's because the pivot was really in the sales market. Interest rates started to go up, and the rental market becomes a lagging indicator of the sales market, right? Sir. So, we got through that. Rental market was hot all the way, like you said, till August, and just seemed like it wasn't going to stop. But we knew it was going to slow down because the sales market was slowing down 2 to 3 months before that. So.
Affordability had to catch up, right? Yep. The interest rates going up, all of that stuff had to catch up, and activity, we definitely saw activity slowing down. I guess I didn't expect the rental activity to slow down quite as much as it did, as quickly as it did, right? That's if I'm looking back on the year. I think that was a surprise to everybody. I've been talking to all my colleagues throughout the country. This is not just a North Texas thing where we are, but throughout the country, colleagues I've spoken to are telling the exact same story that we're seeing.
Mm-hmm. Yeah, and it seems to be, we seem to be a little lucky because I saw some data yesterday that said Texas has actually has had the least downturn in rental rates and slowdown in the market as a whole. I think that has a lot to do with what we've talked about in the past of there's still just a flood of people coming to North Texas. So, the demand isn't as sensitive. Well, but we're getting supply increases, right? Yep. So it's a problem. We've talked about this over the last year, how there's been inventory shortages, supply shortages. That's what was driving up the market rates. And it, you say very quick slowdown. Everyone was surprised. It very quickly went from low inventory to very high inventory. Well, not very high, but
I don't know. You're right. Yes, you're right. Well, when we look at our inventory, right, that's kind of what you're basing that on, because our inventory has gone up significantly, our vacancy inventory. But I think what has happened, my feeling is what has happened is demand has just gone down in the short term for rentals. So I'm talking about tenants looking for a rental is what I'm talking about right now. which goes along with investors looking to buy one, right? The demand has just gone down. I think just right now, I think with interest rates, slowed down investors, right? Because they don't know what to do yet, and they're regrouping and figuring things out. And tenants are in the same boat, man. Inflation, you can't go to the grocery store and you're paying, without realizing you're paying 2-3 times for everything. You're paying more for gas. You're paying more for your insurance. You're paying everything. It seems like everybody's raising prices just to raise prices nowadays.
And when the economy's at its cap and everyone's pocketbooks are at their cap, moving, regardless of how affordable you think your rent is, it's a big expense regardless to move. To take that jump, to move anywhere costs money. And when you're already tapped, sometimes it's easier just to, a lot of people just say, hey, well, we can try to handle the higher rate than try to make this jump and move, especially when everybody was looking, when it was easier to move in the summer was when everything was skyrocketing and inventory was hard. It was hard to move into places. So now that there's more places to move into, it's harder for people to move, and it's less incentivizing for people to move. Nobody likes moving around, nobody, but less people like moving during the holidays. So, and that's why we want to talk about the outlook on 2023, because it's always the January pivot, right? Yep. January is your
2 weeks into January, it all changes.
Well, 2 weeks into January is where you get to set the foundation, right? You get to see, is this going to continue? Is this going to start to pivot and turn? Regardless, it's usually a pivot point of, where do we go from here? So, and where do you think we go from here?
So, just to kind of finish our recap, we had a really strong 2021. It was really good right up until the end here, right? Just to kind of summarize it, right up to the end. Right now, it's really kind of slow.
2022.
Everything's 2022. Sorry, everything's kind of in limbo, and there's questions, and everybody's kind of figuring out the new normal right now. I think is what's happening, right? So as we go into 2023, that's what I expect to continue. I expect that in January, people are going to get back to business, and people are going to need to get back to what they're doing. They're going to want to find the new normal, deal with it, whether it's more expensive or not, right? They're probably all going to go back to their employers and ask for a raise. Tenants will be able to pay their rent. Investors will be able to buy houses again. There will be a new normal. My dad was here for Thanksgiving, and he said, he said, do you realize what I paid, what my interest rate was for my home, the home that you grew up in? And he reminded me that he paid 17% in interest rate at that home. And that was a refinance that he did, and it brought his payment from $200 to $800 a month. Now, that sounds ridiculous to us right now, right? But put yourself in his shoes in 1978, 79, somewhere in there is when he did that.
Well, it's relative too, because I've heard that argument, or I've heard that a lot. But the ratio of cost of living and median income back then, and the price of a house were a lot more in line. Say the median income is 50. Say the median income, just for an easier example, the median income was 50,000, which wasn't true. It's lower than that. Just making.
Okay.
Using 50,000, right? So then you'd have a house that was also 50,000. Okay. So the median income annual salary was pretty close to the sales price of houses.
I think that was fairly.
Yeah, and they were fairly close. They're nowhere near close anymore. For a same 3-bedroom, 2-bath is now $400,000.
Nobody's making $400,000 or $500,000, $600,000 a year.
No, that's not.
Some people are, but
that's not the median. That's definitely not the median. It's actually more like somewhere around 50. But so that same argument doesn't. 17% of 50,000 is also a lesser interest.
No, I got your point. Your housing has become a much higher percentage of your household income than it used to be back then.
Which is why, in those differences in price and cost of real estate is where these interest rates are so heavily. They make such of an impact because they're percentages, right? So 17% of an annual percentage rate on a $500,000 house wouldn't even be feasible for someone who makes $400,000 to $500,000 a year. You know, if we get there again, yeah, that's
We're
why
not
it's
gonna
less
get there.
likely that we're not. Yeah, it's extremely likely we'll
Well,
not get there again.
Okay, so let's talk about. We started talking about what we think is coming up in 2023, and I believe it all starts with interest rates, right? It's like a lot of the discussions we're going to have about current investors and new investors that want to get into the market, and even we want to talk a little bit about short-term rental investors, right? Because that's a big part of the mix nowadays. All of those people are thinking about things. They're basing their decisions. Their basis for their decisions is the interest rates, right? What's happening with them? Is it going to get worse? Is it going to get better? Where's our economy going to go? All those trucks on the road, right? They're all, whether they're full or not, is dependent on interest rates, right? Whether the factories that make the stuff that goes in that trucks are able to buy enough equipment and capital to do that is based on interest rates, right? Like everything in our economy is based on that. So it slows down and it grows based on our interest rates, right? So what do we think is going to happen with the interest rates? All we can do is use our crystal ball based on what experts tell us and what the Fed kind of indicates.
Yeah, I mean, I'd like to look at historical data too and base our assumptions off that. I mean, if you want to talk immediately, the Fed dealt with 2020 and everything till now, the Fed has been behind, right? Even they are now admitting they were extremely behind, even though everybody knew a year ago that they were behind, right? And now they think they're doing, they're probably behind again. They probably needed to stop raising rates 6 months ago. And in 6 months, they're going to be telling us that, just like they did a year ago, right? They're going to be apologizing for behind. And in reality, the goal is likely a recession. Recessions don't always happen by accident. So, that's part of the outlook. But we're talking about rental rates and real estate prices here. And, they're a big part of where recessions start and end. Like the interest rates. Interest rates don't necessarily directly affect cash buyers, right? Like, so the investor with cash to spend if values go down, they're the ones who help catch the market in a sense, because there's a price where they start buying up all the real estate again. So.
Yeah, to some degree that's true. Some people have cash because they've leveraged something else, which the interest rates do affect, right?
Yep.
So what I mean by that is they've taken cash out of another property or a different asset and they've taken a loan out on that, and those interest rates do affect where they got that cash. So there's a percentage of them that are what I just described, and there's a percentage of them that already have the cash sitting around. They need to do something with it. And those are the people that are going to benefit the most from 2023, because they're going to start getting good deals, or what they perceive to be good deals based on where the current market value is.
Yeah, that's what I was getting at too. They're the ones who will start the foundation of wherever the next market goes, because they start buying stuff up, and then there's if that creates more inventory. So, but people moving and things getting, they call it consolidation periods. They're good. They're good for any market to have a consolidation period because it confirms pricing. So it's not necessarily a decline. If you have, we've experienced a lot over the last year of landlords and people going over market rent. So just because they could get it, right? Well, just because you can get it doesn't mean that when you're in a normal inventory environment that you're still going to get it. And this is a conversation we have to have with our clients sometimes. It's like, well, this house got this 3 months ago. Well, you're in middle of an inflated market 3 months ago, and maybe they got a little bit more than they should have, but you got to be to succeed in any market, you have to be realistic with price.
Well,
right?
Okay, so that's a good point. So we were talking about new investors and coming into the market and what they can expect. Let's finish that, and let's talk about rents, what we think's going to happen with rents. So investors coming into the market should, I think, expect more interest rate hikes. I am hoping, and everybody is hoping, but is not certain of, that they will be less severe and that they will slow down and finally come to a halt sometime in 2023. Most people believe that the summer of 2023 that they'll finally stop. I don't think anybody knows that until they actually come out and do their big meeting and say what they're going to do, right?
Yeah, and it's been predicted that it'll be the end of the year, and all the Fed wants to say all year last year, they're looking at data. They're data driven. They're ignoring everything else, all the noise. They're data driven. Well, one piece of data I know they look at is the 10-year curve, right? And the curve yield inverting, right? And
Kyle's getting over our head now.
no, I mean it's the 3-month yield curve inverted yesterday, right? So that's like
I don't know. My
piece of data
my
that
curve inverted downwards and it hit the plate and I got a strike, and that's all I know.
You don't need to know what it means, sure, but it's a piece of data that the Fed would look at and say, okay, well, that's an indicator that says we need to slow down rate hikes. That's a stronger indicator.
So are you saying that they got indications that they need to slow down right now because of whatever you just said?
Yeah. Well, whatever I just said indicated the last. We won't get into that.
See, I like to play. You know how people play good cop, bad cop. I like to play dumb guy, smart guy over here. Like I'll let you be the smart guy and I'll be the dumb guy.
Well, okay, we're talking about interest rates. Let's dumb this down. If I borrowed $100 from you and I asked you, I'll give you, and I owe you $10 for borrowing that $100. So I owe you $110 back, right?
Yeah.
I'll give you your $110 back in 3 months or in a year. What would you pick?
I'll take it in 3 months, please.
Exactly.
Yep.
Why would I even give you those two offers? What if I told you I'll give you?
Because you're now the dumb guy.
Yeah, sounds dumb, right? Well, when that thing inverts that I just mentioned, that's what's happening. It is more incentivizing to take out loans from the government that they will pay you back in 3 months than in a year.
Okay.
And that's not good for the government. They want to pay you back as far as they can.
They want to pay you back never.
And the Federal Reserve is responsible for making sure that doesn't happen, right? So those are one of the triggers that, hopefully stop them from doing the things that they're doing.
So interest rates. So I'm hearing, and it sounds like you're confirming what you're seeing in the financial world is the interest rates should continue to rise in 2023, but slow down and stop sometime in 2023, right?
Yeah.
We're probably looking at the 7s.
Well, you got to ask yourself, this is what these cycles are about. What caused interest rates to get to an all-time low in 2020 and 2021? Absolute lowest they've ever been.
They were pushed down that way politically. They were
cut to zero.
Yeah. Well,
the Federal Reserve rate was
that's been the case since the year 2000.
No.
Yeah.
No.
They've been artificially buying mortgage-backed securities, and now you got me doing it.
Yes. No. Okay. But those things are true. We're not getting into that. I'm saying what triggered the. So in January of 2020, you could get a mortgage.
Is COVID the answer you're looking for here?
Not COVID. COVID caused an extreme economic decline.
Okay.
It was stimulation. It was stimulation of the economy, right?
Yes.
So in order for rates to go back down again when we're in an inflationary environment, there's got to be some need to stimulate the economy, right? So either a consolidation period will help rates get back down, or some kind of recession will help rates get back down. So it's a bob and weave. And that's what the Fed's looking for.
Well, I got that. So what do we think is going to happen with interest rates in 2023 then?
Given what I just said, I think they will stop hiking at the end of this year or the beginning of next year. But the effects of rate hikes take 3 to 6 months.
Yep, at least.
So,
do you think that
I think they will be stabilizing in 2023 and probably begin to decline towards the end of 2023.
In the 7s?
What? I don't know.
In the 7s?
Can't get
We're talking mortgage rates here.
So.
Well, that's what
it's all based on the Federal Reserve rate.
Most of the experts I am listening to think that that's where we will end up. That's where our peak will be, is in the 7s, which ironically, we've said this many times, ironically is our historical average. Mm-hmm. If you look over the course of the last 120 years or something since we've been keeping tabs on mortgage rates, The historical average is 7.75. So kind of ironic that we're all freaking out that it's getting back up to that historical average. But that's the reality, is the world we live in, the last 2-3 generations they're used to low interest rates. And so this is kind of our new norm, right?
So it's affordability and how cheap money is.
Right? All right. So people who have cash are in a really good spot. People who don't have cash and they need a loan, right, are in for a little bit more pain. They've got to pick and choose what they buy. And Kyle, let's talk to that investor real quick, though. Can we do that?
Yeah.
Because you and I think, are of the same mindset that all of this stuff matters for your short-term outlook, but in your long-term outlook, if I'm 25, if I'm 30, 35 years old, looking to buy my first rental property or my second or third rental property, I'm doing that for a long-term gain, right? I'm not doing that to make $300. I mean, obviously everyone wants to make $300 a month on every one of the rentals, but that's not the important thing. The important thing is to acquire as much real estate as you can and hang on to it. And these cycles of interest rates and all that stuff don't really matter. It's kind of like doing a long play in the stock market. Doesn't matter where you buy, just buy and get in. And if it goes up afterwards, great. And if it goes down afterwards, it doesn't matter. It'll bounce back up.
No, that's true. And, it's get into the market. As we've talked a lot about, there's different tools, there's different methods. You always, if you can't win a game, you're not playing. And,
yep.
You got to the best time to plant your tree is now.
Yep.
All those things still apply.
Yep.
It's all about just knowing what environment and what's going on so that you know which route to go. A year ago when rates were insanely low, it wasn't much decision making. It was, all right, if I'm gonna buy this piece of real estate with a mortgage, just a normal conventional mortgage. It's because it was the best tool. It was the best method. As the market changes, there's different ways. So these are the markets where, crowdfunding real estate syndications become popular, or more prevalent, I should say, where investors fund deals together with their cash so that interest rate isn't affecting that cash. Well, you may have a smaller piece. You're still proportionally in the deal with the amount of cash that you put in, right?
Yep.
You have a whole nother discussion about those, but that is what is commonly done when interest rates are affecting. Find a way to buy real estate in a cash way.
Love it.
REITs are. We will not talk deeply about REITs, but those are another way to just put your cash in real estate. So.
Yeah, I love it. So to your point, there's a whole bunch of ways to invest in real estate. So you can go buy a piece of property and do what's traditionally done, or you can go invest into a REIT, in which you can find on the open stock market a lot of times, or you can find, we've got a syndication deal we're putting together now. There's a lot of people putting syndication deals together like you described, and we should probably do another podcast on that, separately.
Yeah.
But yeah, so there's a lot of ways to invest. So my encouragement to everyone out there thinking about investing is don't let 2023 slow you down and stop you from continuing toward that task. There's nothing wrong with putting on the brakes and being more careful. That's where I think 2023 should be, is investors just need to be more careful. They should be looking for better deals because they're out there now, right?
Yes.
Don't be so quick to just go buy something just because. But that doesn't mean stop and don't execute. You should execute. You should be buying. I got an investor I talked to last night, just closed on 2 more, right?
Yeah, it's just
they're getting deals.
Hindsight's 2020, right? And people say, oh wait, when investors bought everything up, it's some investors, that's most money they ever made. They sold it maybe this year or last year or whatever. That dip that was experienced was completely different. That recession was for I don't want to scare people about prices. That was just an opportunity, right? Every time you have uncertainty in any market is an opportunity. That's what Warren Buffett says. When people are fearful, be greedy. When people are greedy, be fearful. So And right now people are being fearful.
I'm
tired of hearing. I think I hear the word uncertainty anytime I turn on any piece of technology. Really tired of hearing that word, but it's the world telling you they're uncertain. So be certain about your plan and be greedy.
I love it when everyone else. I guess I would say the same thing a different way. When everyone else is freaking out, that's the time for you to go get it. Go. That's the time to eat. I've been telling people for probably the past 6 months that now's the time to eat. Let's get it. Now's the time. That means, what I mean by that is as an investor, as somebody that is able and willing to invest and put their money into real estate, now's the time for them to be really gobbling it up.
Yeah, because primary homeowners were the ones buying, and a lot of the last year or so with the movement around and everything. But surprisingly, investors were the ones selling or holding, right? Because investors don't like to compete in multiple 20+ offer situations with going thousands of dollars over asking price. Those aren't the environments investors like, this is time to buy real estate. No, it's when you're not competing and you're looking for deals, and the deals are out there, right?
And they're coming to you now.
Yeah, they're coming to you. And I mean, the wholesaling's back. Off-market deals are back. I mean, it's came back almost overnight. Off-market deals are like, we're getting flooded with them. So, you have any interest in those, give us a call as well. So.
Private investors, private lenders are going to get stuff back, right? Foreclosures, we are going to have, some foreclosures come back, and probably not too much, but there'll be a small amount. And a lot of those asset managers are looking at property management, looking at buy and hold strategies to hang on to. I mean, I'm hearing a lot about this. Like, banks are not afraid to hang on to properties, let a property manager manage them for a period of time until they deem it appropriate to sell that property. That's a strategy that they're using. So there's a lot of stuff going on that I think it's good stuff for investors. And even if you're not in the game yet, you wouldn't consider yourself an investor, there's so many ways to get into the game. I hope that's what we're demonstrating here, that you don't have to be high level. You don't have to understand all this stuff. It is easy to get in. Just find a way to get into the game, start building wealth for yourself, because everybody out there, from the small investor to the billionaire, will tell you today, in December 2022, they will tell you real estate is still the best way to build wealth.
Yep, that's how they.
Is it Bitcoin?
No.
Is Bitcoin? Bitcoin crashed and burned, I think, didn't it?
It does. Bitcoin isn't necessarily building wealth. It's just.
That's speculative. That's speculative investment, and that's why we push real estate so hard. It's like it gets you the best returns. It's not speculative. We've been buying houses for centuries, right? Like, we know what it does for your wealth.
And the reason we want talking outlook and what your focus should always be outlook, because while it's good to recap. When you're making a decision to invest in real estate, because of everything we just said and how it is the primary source to build wealth, you need to just look at the current situation and execute from that. You can't be like, well, it was this way a year ago, or I could have got this rate. Now I'm going to wait for this rate and this price. Like, the past doesn't really matter in real estate.
Yep.
You have the future, and you don't want to be the one predicting that way yourself out of it, because there's times where I've seen investors say, I need to wait for this to happen again, and then something happens where they need their money and they end up having to sell at the worst time, right? Take control of whatever your investment decisions are. So there's our outlook, general as it is, it should be.
Let's talk about rents, Kyle. So because we got a lot of investors out there wondering what's going to happen with rents, right? So people that are currently investing, what do you think? What do you think is going to happen with rents this year?
Going in the end of the year, or
just in 2023? I mean, I definitely have an opinion. I definitely think I know what's going to happen with rents. My fingers on the pulse of
I touched
rents.
on it a little bit. I think that we'll be entering a consolidation period. So I don't like to stick a word like going down or going up or staying steady. It's consolidation has its name because it consolidates things to where they should be, right? So like the market we just came out of, you had a wide range. Like you could have one property that could have been a $600 swing, right? Just as an example on what that rent rate went for a variety of factors. So consolidation is over time making sure that the market finds its baseline of where it should be, so it can continue in an appreciative manner. So
yeah, well,
I think we're going to stabilize and consolidate.
I think that's what you just said.
Yeah.
Yep, that's a good summary of what you just said, and I think I agree with you 100%. I think we've been stabilizing, and I think that will continue. But I do think people need to be weary and careful about pricing right now.
Yes.
Our market for rentals has come to a halt, right? Like not a lot of people doing it. I know that's going to change, especially in January. I feel like, everyone will start back up again, right? It'll be fine. But even still, what we're seeing is desperation out there. And you have to remember that 9 out of 10 rental properties are not professionally managed. So what that means is people are out there making extreme fear-based decisions, and they're freaking out, right? And because they're freaking out, we have to adjust. We're forced to adjust because we have to compete with them, right? So we have to be careful as investors to be cognizant of what's happening around us, and when we have a property, being really, really careful about, it doesn't matter that 3 months ago somebody got $2,400 a month down the street for the same house. That doesn't matter if they can go around the corner and find one that's actively on the market right now for $1,800. Like, why would they go look at your house for $2,400 when they can get one for $1,800? And we've talked about how vacancy kills you right now, right?
Vacancy kills, and
if you have a vacant house, that's costing you money every day. Pricing it wrong will cost you way more money than that difference in price.
Yeah, and we've talked about this so much, and this is what investor mindset is commonly not in line with and should be, is that market rate is decided by the market. It is not. We do not pick market rate. We can calculate it, determine it, figure it out, based on expertise and that kind of thing. But it's called market rate because it is the rate that the market or that somebody will pay for the home, right? Based on all factors, economic factors, inventory, desperation, supply, demand, all those things. Those things have changed, and if you ignore that they change, then you're just ignoring what your rate. Your rate is what you want it to be, and what you want it to be is not the best way to market a property.
Yeah, and there's two different ways to look at it. So if I could give two examples of conversations I have with investors, let's do this. Two different examples. One is, and both of these are happening right now, it really depends on the neighborhood, right? It is all over the place. Every neighborhood is different. And right now, you don't have as much data as you normally do. So what I mean by that is normally if I run comps, as we call it, right? If I look to see what comparable homes have leased and are leasing, in a large neighborhood, I'll get 10 to 15, right, points of data to make a great decision. And right now, I'm getting like 2 or 3, right? It's hard to make a decision based on that, right? So we're having to make our decisions a little differently and extrapolate out a little bit. But here's the two conversations I'm having. I want to list something at $2,200 because nothing in that neighborhood has rented for more than $2,200, but my investor comes to me and says, well, there's a house around the corner that listed or that rented for $2,400. That's what they'll tell me. And I'll look it up, and it's an active listing. And I'm like, okay, well, they haven't succeeded. They're just trying. That doesn't mean anything. Just because you've gone on Zillow and found something around the corner for $2,400 doesn't mean that that's the best move for you to list at, right? Nobody in the neighborhood's done that. So I have that conversation all the time. We have the reverse conversation where we're like, okay, we have a bunch of listings that let's use the same numbers. 2,400 is for the past 3 months, we can see homes have leased for 2,400, right? But are we gonna ignore the brand new listings that are out there for $1,800 a month or $2,000 a month and just pretend they don't exist?
Those estimates will.
Those estimates will do that.
It's these markets where you get to really see how inaccurate his estimates are.
Zillow and Redfin just create so much conversation for real estate agents and property managers.
Data points, right? And when data points are in surplus, like they were, like you described, they're fairly accurate. When you have to use expertise, perspective, competition-based things, those are way harder for algorithms and stuff to determine accurately, right? You may even know because you went by that there's a house 3 doors down that's under renovation, but it's coming on in the next 3 weeks, and this is what they're they're going to rent it for. So what does that tell you? You need to be rented in the next 3 weeks if you're going to be at a higher number. You need to be competitive with them after they go on. So, especially if it's directly comparable. So those are things where expertise and just operating in the market environment that you're in gets to become so important. Yep. So, and that's where we think rents are going to go stabilize to where.
Yeah, you know what, Kyle? If I had to put a number on it, I would say over the course of the entire year, we are going to see a flattening to a decline of about 10% of rents depending on your neighborhood and your area. So I think every area is going to be different. Some of them are just going to stay flat through the year, and some of them are actually going to have a small decline, which I don't think is that inappropriate considering what we've seen with rents over the past 2 years have skyrocketed at an enormous rate, right? That it was not sustainable. So a small pullback of 8 to 10% is what most people are predicting, and I don't think that that's here where we are. That could be more in other parts of the country, right? I'm just talking where we are. And I don't think a pullback of 8 to 10% is that inappropriate. However, I guess what I'm trying to say is if you've got a current tenant and you're doing a renewal, and
be more conservative on
be more conservative,
off, right?
Don't scare them off, and those are going to stay flat. They're going to stay fairly flat for the reasons that you suggested, that it also costs a lot of money to move, and just don't run them out.
Well, and that's what I was going to say. I think one of our biggest factors in 2023 is actually going to be, forgetting the word for it, but how many people move, like how much moving around is going on after these leases expire. And because that's really what drove up the rental market in a sense, was all the moving around. We also have a timeline factor that not many people talk about right now, but has never really been a factor, was the eviction moratorium, which this is so far in the past, or feels so far in the past, right? Well, it ended about a year ago. So think about that. People were locked into free homes or whatever. They could have been not paying the rent for a year, didn't have to move, and then I know it changed in different parts of the country. In Texas, it was a little bit earlier, but most of the country, it was around August of 2021. So at that point, moratorium's gone, your free housing's gone, everyone starts moving, right? On top of all the moving that was already happening. So,
well, what about rent relief? You're talking about rent relief is they are all the rent relief funds are ending and being exhausted right now.
Yes, so people that
we're getting our last checks right now
haven't been able to afford these homes for a while now. We're getting, I call it more than assistance.
Couldn't or wouldn't afford them.
Yeah, whatever it is. But the point is, those things trigger moving at a massive scale, and it can either be good for the market or bad depending on where that falls in desperation. Like you said, if you get desperate and people start freaking out too early, and then people start moving. Now they're chopping at chopping things down, where if it happens the other way around, where people start moving before the market gets fearful, that stabilizes it and keeps it where it's at. So,
the other thing is the other effect interest rate is going to have, it's going to swell our market for tenants. There's a lot of people out there that would be buying that aren't going to buy until interest rates go down. That is going to create a larger share of the market for rentals.
For rentals, yeah.
And so at some point that is going to have an impact on our rental market, which I think that is the single reason why we are only going to see at most an 8 to 10% drop in our rental rates.
Yeah.
And I think a lot of places are going to stay flat. I think most good rental markets are going to stay flat. I think some of them that are grossly overpriced will probably come down a little bit. But for the most part, I think rents are going to be fine. I just think that people cannot expect to continue raising their rental rates the way they have been through 2021 and 22. I'm being a lot more careful at renewal time right now about where I'm raising rents to, if at all. I think, as a matter of fact, this past month when we did them, I think I had the most I've ever seen of our renewals, the highest percentage of our renewals that I didn't raise at all, right? Like, I think there was, I don't know, I think I did 12 or 13 of them, and 3 or 4 of them I didn't even raise because we were over, right, market price, right, like right now. And it's really important that you look at it correctly. I mean, I know most people don't have somebody looking at it the way I'm looking at it, and that's unfortunate for them because all they have is Zillow and Redfin. And that's not good enough. You need some professional help. You don't have to have a professional manager, but you need somebody that's got access to the data to be able to help you price these things correctly.
And knowledge and experience, you know.
Yep.
It's like these timeline things, these rent relief timelines and the moratorium timelines, I guarantee you, 99% of people pricing are not even thinking about that.
People aren't even thinking about what's happening in Dallas right now, which is a completely different story, but stuff's happening in Dallas right now.
Different things are happening all over the country too. So it's just hard, and it's harder to look at it and get a clear picture. So you want to make sure you have someone with a lens that you can look through and see something. So so that's where we're at with rents. Hope this was insightful for everybody. Our outlook into.
We're gonna do a separate one on short-term rentals.
Yeah, we'll do a separate one on short-term rentals because we could.
It's different, isn't it?
It is different, and it's just a whole different market. It really is.
We do that next week.
And the sales and rental market has affected the short-term rental market a lot differently in the last year. So we will let's teasing you all with short-term rental outlook for 2023.
Let's do that next week, and that might wrap up our 2022 podcast before we get into 2023, huh?
Yep. All right. Well, everybody, that's it for me. Assume that's it for John on our outlook. And if you guys have any questions, want to discuss our outlook, or start investing, get into syndications, any of that, 817-818-9039.
Where can they send the email?
ShowMeTheMoney at wearetpm.com. Thank you all for tuning in, and we are out.
Later.